What's up, everyone? This is the Nakamoto Portfolio Gauntlet, a show where investment funds can explore Bitcoin on their balance sheets risk-free. I'm your host, Dom Bay, and I'm a firefighter on a mission to bring Bitcoin to unions, pension funds, and workers everywhere. So what's the Gauntlet? My co-host, Rapha Zigury, created a groundbreaking tool to input Bitcoin into any investment portfolio and model the impact. Of course, if we're going to run a gauntlet, we need some backup. So we brought in the legendary Greg Foss and Joe Carlasare. At the end of each episode, which you will hang around for, we jump into the hot seat as the hosts and make a hypothetical Bitcoin allocation for our fund in focus, as if we called the shots ourselves. So get your mouthpiece in, mount up, and let's run the gauntlet. I see my co-hosts are here, Rapha, Greg, Joe. What is up? How are you guys doing?
Very good, Dom. Great to be here.
Yeah, it's great to have us back. Episode 2. This one's going to be fun. Good to see you, Greg, and Alpha Zeta, and Dom.
I think we got Greg off on mute right now.
That'll be the first time.
Thank you, Joe. Thank you. Yes, sir. Thanks for having me, Dom. Everyone, I hold firefighters in high regard, first responders of all types. I'd like to say I'm a firefighter trying to put out fires in Fiat land. Let's see where we can take this conversation. But very much looking forward to the gentleman that we have as guests today. Thanks.
Yeah, and hey, a lot has changed, right, since our last show just over a month ago. The Bitcoin spot ETF conversation is heating up. We obviously got some clarification from the grayscale appeal, although there's much still in the wings waiting, as Joe always points out.
And huge win. It's a huge win. I mean, there's no way of sugarcoating it, undermining it. It is a massive success for them to meet the high standard, which is one of the highest in the law. They have to prove a government regulator was acting arbitrary and capricious, right? It's very seldom done, and they did. So there's no way you can paint this as anything other than very, very bullish for us eventually getting a Bitcoin spot ETF in the United States.
Yeah, it's always interesting as their trajectory of Bitcoin, kind of continues to go up. Sometimes the price doesn't always fall along. So we do have to have a truth session where we look at our allocation for Ontario. And I think we're a little down on that, but not too much. But we'll discuss that later. Rapha has that, and we'll be able to take a look. So without further ado, I want to introduce our guests today. And they're we have some amazing guests. So first, we have Mahlon Mitchell, the president of the Professional Firefighters of Wisconsin. And along with him, his secretary-treasurer, Stephen Wilding, who is the secretary-treasurer of the Professional Firefighters of Wisconsin, as well as the chair of the Wisconsin Retirement Board, part of the Wisconsin Retirement System, which serves, I believe, correct me if I'm wrong, Steve and Mahlon, over 600,000 retirees and employees. On top of that, Mahlon and Steve, we know you're super busy overseeing the State Firefighter Association, which has over 4,000 active firefighters. So y'all are extremely busy, and we appreciate you coming on. Why don't you guys just give us a brief intro and kind of like some very brief things on what you guys are working on.
Yeah, thanks, Dom. Like you said, my name is Mahlon Mitchell. I've been in my post as president of Professional Firefighters since 2011, right when Scott Walker actually, if you remember, Act 10, and when we stormed the Capitol and we were there with teachers and other labor leaders, when he essentially took away the ability for other unions to collectively bargain. We were initially exempt, but we made sure that we were there with our brothers and sisters. That's when I took the helm, actually, probably 6 days before Scott Walker put in his union busting legislation, we like to call it. So I've been in that post since 2011. I also serve as president of my local Firefighters Local 311 right here in Madison, Wisconsin. We're local about 500 members. And I've been on the job in Madison for 27 years. I got hired at the ripe age of 19 years old, so I was lucky and fortunate, and been in our WRS pension system that long as well. So it's great to be here. Some of the things we're working on, the state association, our main focus, and really any state association in IFF. the main focus is advancing the interests of firefighters through legislation. So I'm a lobbyist and just a lobbyist for firefighters, for our firefighters. And my main job and focus, 5 out of the 7 of our core objectives, are to advance the interests of firefighters through legislation. And 5 of our 7 core objectives are political. So our job is to make sure that we're doing all the training, making sure that our legislators know who we are, what we do, and what we need to do our job successfully. So I'll end it there. I can talk all day, but I also have a cloudy screen that pisses me off.
Yeah, for those that can't see past the cloudy screen, Mahlon does not look like he has 27 years on the job, and he's actively young. We'll say always out and about. And yeah, man, very cool to hear. Steve, how are you doing, buddy?
Good. Thanks for having me. So I just retired about 2 years ago. Oak Creek Fire Department for 33 and a half years. I took over for our previous secretary treasurer back in 2010 and have held that post ever since. Really, Mahlon focuses on the legislation, and our vice president and myself, our vice president, Mike Wadzicka, and I really support Mahlon in those endeavors. So we kind of serpentine through all of our issues and really focus on making sure that we're representing our 4,000 people through our leader, Mahlon Mitchell. So with that, I'm ready to rock and roll on this. So
very cool. And for those listening, I know that Mahlon and Steve told me very clearly they know little to nothing about Bitcoin, but that is okay because we're here in the Gauntlet. And even though the name's the Gauntlet, this is a safe place where we're on your guys' side trying to figure some of this stuff out. Before we get into Bitcoin real quick, the Wisconsin retirement system is one of the healthiest pension systems in the nation. In 2021, as far as I know, it was 106% funded, so above 100% funded. I know through some turbulent times, I think that number might be at like 99% or 100 right now. You guys can let me know what the latest is. But, a lot of money under management, I think 140 billion, the 8th largest pension. How have you guys been able to maintain such a healthy status? If you can give us just a very brief overview of that.
So I'll take a stab at that. So what happens in our system is a little bit different than other systems. It's really 3 major participants. It's the employees, the employers, and taxpayers, and our retirees. So those 3 groups actually make up our system. There is no cost of living increases or anything else. So as the fund does well, so does everyone else in the fund. So there are no extra added internal costs, or excuse me, not internal costs, but no automatic escalators into our cost. So as we go, so does the fund. So that's really, it's just that simple.
Great. That's great. And you guys have any questions as far as Joe, Greg, Rapha on the fund itself before we dive into like what does Bitcoin mean to an institutional fund? Why get involved? What are some of the benefits, risks, etc.?
I'll just make a comment that that's a lot of money. 140 billion. Congratulations, gentlemen, and your female partners as well in the fund. It's remarkable. It's easier to have a fully funded pension when it doesn't have as many beneficiaries and fiduciaries. So comment from Canada. Some people may know or may not know, we are far less diversified in Canada with our pension system. In that the largest 40 accounts in Canada on a relative basis are far more powerful than the 40 top funds in the US. For example, the largest fund in the US, CalPERS, we have a fund in Canada that is on a relative basis much more powerful than CalPERS, just in terms of the percentage of assets that are held. So the United States pension system is different, more diversified, lots of out of the box thinkers. And I like to say that out of the box thinking allows for returns that reflect proper risk management. So congrats on that. Clearly you're doing something right. Most of the funds in Canada tend to be followers. They all want to be what's called a theory of agent, where as long as everybody else goes down the sewer at the same time, everything is fine because you're doing exactly what everyone else is doing. Whereas in the United States, I find that people think outside of the box. They're not as concerned about the theory of agents, and allows different funds to put on better performance returns. So looking forward to this conversation.
Yeah, I'll just say, as a resident of the state of Illinois, to echo Greg's comments here, you know, we have our pension system funded, I think, somewhere between 40 to 50% in terms of assets to liabilities. So definitely envious of those folks who are in a better position, and definitely something that we want to explore on this program and sort of challenge with proper risk management, how to move forward and sort of capture opportunities that are out there. So thanks for joining us.
I would finalize saying two things. First of all, I'm not nearly as lucky. I live in a country that has a pension system that is completely broken. And I would say it's broken for something that we're going to discuss here today a lot, which is the currency. Unfortunately, Brazil has been through its cycles of hyperinflation, and even pensions that were funded in the past. What happened is that they had capital, but the capital was worthless. So the capital that the retirees were receiving that before could buy them a meal now doesn't buy them a cup of coffee, and that's something that I think gets lost when we think about currencies in the long term. But in the long term, we see this happening a lot. But another thing I wanted to say, for preparation for this show, we went through the data, took a look at the website of the Wisconsin system, and I was actually very impressed by, first of all, the transparency. There's a lot of data, a lot of information, and I think that's really, really good. First, it of course made my job much easier when analyzing the performance and looking at suggestions, but also, and more importantly, right, if I am a participant there, I want to see the transparency. I want to see what the investments are. I want to see where the direction is heading, and the quality of the information there is very, very good. And it's not only that, I've seen that they went far and beyond. They make available like stress testing. I was very impressed with the quality, again, of the materials that we got there, and it'll be very, very exciting to go through them today.
I think one of the keys too, Dom, is that, and Steve knows a lot more about the pension system than I do, and he's an annuitant now, so of course he's paying a lot closer attention. But I think one of the benefits of our pension system is that it's legal to rate it when times are good. And I think what we're seeing around, at least our country, I can speak to, and like places like Illinois and other pension systems where, in 2004, 2005, when they were making great returns, killing projections, they went and took money from the pension system, or they took holidays, cities took holidays, didn't pay into the pension system because times were so good and they were making their marks. Well, obviously, as we know when 2008 came, that's when pension systems really took a hit. We had a governor years back that actually did raid the pension system, but he was told he had to put the money back because the legislature came in and lawyers came in and said you can't do that. So I think one of the benefits of our pension system and why it is so healthy is because you cannot take holidays when times are good.
And Mahlon, there is a pension system close by to you guys that didn't fare as well. And as far as I know the history, one of the pensions that didn't join the Wisconsin retirement system was Milwaukee's municipal pension. And I know recently they are joining, right? They're kind of, any new members of public safety will be a part of the Wisconsin retirement system, and they had to do a sales tax to address some of the shortfalls. Do I have that right as far as Milwaukee and where they were at?
Yeah, they basically needed what's called a legacy fund, and that's this 2-cent sales tax in order to actually make their pension whole and to actually take care of their liabilities. And with that, the state legislature put in place that they could do the sales tax. They had to pass it by a common council vote. That money is going to be strictly to address their pension shortfalls. And with that, any new members hired. Now, Milwaukee has Milwaukee County and a Milwaukee City pension. Milwaukee is in Milwaukee County. So they have both pension systems, and both are really underwater, so to speak. And the reason is because they took the holidays back when they could, when times were good, and of course didn't put the money, the employer side did not put the money in when times were good. So again, when 2008-9 happened, it just went to shit. I'm sorry. Can we curse on this or no?
Oh yeah, Foss is a frequent violator.
So I went to crap.
Yeah. Well, it's interesting to fund like that because, and again, why Bitcoin? Bitcoin was something that I discovered and I was attracted to it and learned more. And the more I learned about it, the more I realized its benefits. And one of those benefits being that it's outside of the financial system, the legacy system, which in 2008, caused so much pain to pensions across the countries. And the more I learn about pensions, I realize how they've been trying to recover since 2008. And that wasn't a Bitcoin thing. That was before the time of Bitcoin. That was the housing crash. And of course, as we know, and you guys know as representatives for employees, it's always easier to take a couple, some money from the masses than it is to take it from, the institutions high up. And so that's what really turned me on to Bitcoin. And I think for a fund like your guys, maybe one place to start off is, I see Bitcoin being something more of like an accessory kind of having a hedge facets on the side outside of the system, because the system you guys have is already doing quite well and finding ways that it can kind of supplement. Whereas for something like CalPERS, that's 72% funded, that has been front run with funds and is still trying to catch up, they're kind of in a spot where how do you get up to a status like you guys without taking major swings? And we're starting to see a couple more of those swings carry out in real time with leverage and borrowing money and private placement, emphasis on private placement. So I think a good place to start is like, I don't know, how do you guys see Bitcoin? Obviously, some initial thoughts and how do you view it as fitting in a portfolio? Or even why would you not look at it as a portfolio?
Hey, Dom, before we go to that, can I just ask a quick question of Steve and anyone who might have some knowledge on the Wisconsin plan? So my understanding when I was preparing for this episode is that Wisconsin's kind of already like an innovator in terms of its approach, and it created this sort of dual structure where it has both sort of a defined benefit and a defined contribution section, similar to like a 401k. So there's already a precedent sort of in Wisconsin for being innovative, and that I think dovetails well with Bitcoin, sort of talking about Bitcoin. Can somebody explain any more of that if you have any more details? And if not, we can move on. I was just curious if you could give the audience a little bit more of a background of why Wisconsin has been innovative in that approach.
Mahlon, you or me?
Go ahead, Steve.
Okay, so I think what you're asking is the defined contribution is the pension part of what we got going on,
right?
And then they do also run a 457 plan through their system, their deferred compensation plan, which is completely different and separate from the actual pension itself. So there's a different board that actually runs that.
Okay.
But it does give you the ability to jump into that system. And Wisconsin, in its constitution, basically states that it cannot make money. It is not for profit. So one of the unique things that for our 457 plans is that they are really cheap for the employees to get into, and the administrative costs are very, very low. So you actually get a great return on your money through those 457 plans.
Gotcha. Okay. That explains it. Thank you for clarifying that. Sorry, Dom.
No, all good.
The one thing I wanted to add, Dom, if I could, our system is unique in that we have our own investment board. So it's called SWIB, Wisconsin Investment Board. And one of the things that it does is probably invests about over 50%, I'd say like 55% of our $130 billion. So they're in charge of moving that around. So they're not they're not paying a bunch of people to move around money. And so our costs are lower on the back end just because we're doing much of that work ourselves. The board, not us, obviously.
Yeah, for sure. No, that's a definite net positive. And when you think about some of the larger funds where there's a lot of hands in the pot that are kind of like directing things in multiple places, that seems like a key part for the success. Kind of jumping into Bitcoin a little bit, let's just say hypothetically, if you guys brought the idea to the fund, are they saying, hey, Steve, thanks, there's a box at your desk, just load everything in the box, and thanks for serving us, take care? What's the vibe like? Are people kind of dismissive? Is it too early? What is your kind of, if you've heard anything at all, or thoughts on what would be the response?
We have not. So our structure is our secretary who runs the Wisconsin retirement system. John Volker is his name. He is our representative from ETF onto the SWIB board. So he actually is in all of their meetings and making sure that they're delivering exactly what we're looking for to keep that fund solvent. So we don't really have any, obviously the SWIB board, the president comes and gives reports once or twice a year to our board. But we don't really have any interaction with them other than through our secretary, John Volker.
Got it.
I can't say this. There was a letter, our last board meeting, there was a annuitant that actually wrote a letter to the WRS and asked if we were in Bitcoin. And the PR department or whoever, takes care of those type of letters just gave a one sentence, we don't own Bitcoin. And it was just that simple. There was a small explanation, and maybe you guys can help me understand, but the explanation that we got was we don't actually own Bitcoin, but we do have some investments in how they process it.
Blockchain, probably blockchain. This is what we normally hear with a lot of my clients.
Or Bitcoin mining. You never know, Joe. Yeah. It could be the blockchain, which there's no blockchain except Bitcoin. And it could be Bitcoin miners, because the largest owners of Bitcoin miners right now are BlackRock and Vanguard. And I'm not sure if you have exposure to either of those ETFs, or not ETFs, but asset managers, guys. But if you do, there's a chance that you have exposure to Bitcoin miners through their diversified portfolio holdings.
So that, I guess that would make sense. So they have something. It just wasn't Bitcoin itself.
Well, this is going to be a great conversation because there's a lot of learning that takes place. And sometimes the answer is we don't own it, but we're evaluating it. And that would be the answer that I hope that all pension plans in the world would respond with. Because in my opinion, and I'll just cut to the chase, I think Bitcoin, as Dom said, can be viewed by different funds as different things. I view Bitcoin as insurance. I'm a credit trader. I view the world through a credit lens. And insurance is your most important asset in many cases. And I believe Bitcoin to be the ultimate insurance policy against the traditional finance system. So if I leave you with one thought, gentlemen, it's don't be too smart by a half, which is to say, oh, our fund is at 100% funded. We don't have to look out for new risks in the world. I would encourage you and congratulate you for your performance. And obviously that's because you anticipate where the world is going, not where the world has been. So Bitcoin is a new investment, a new asset class that will generate incredible attention. And I think this is a great starting point for that process to occur within Wisconsin, and then also your state of Wisconsin investment board. That is where the decisions get made. And sometimes it trickles upwards, right, guys? Sometimes the information goes up to the investment board. It doesn't trickle down from the investment board to the pensioners. So let's get it going.
Yeah, I think we talk a lot about this spot ETF that's on the verge right now, and you guys may have seen it in the news. Steve and Mahlon with like it's a very hot topic in Bitcoin right now. Go ahead, Joe.
No, I'm sorry, I cut you off. Finish.
No. Get in there. Get in there.
Okay, so here's the thing: when you start bringing up these discussions with anyone from traditional finance, generally there tends to be a lot of confusion, because I think if your head is not in this space, like Greg and others on this call, you tend to, I think, sort of misread the landscape of what the public sees as this space. They tend to lump it all together. They all say that's that new stuff, that crypto, that blockchain, that mining. It's all sort of one monolithic. And the reality is, and we'll get into this somewhat here in this call, the reality is that there's a tremendous amount of difference. You kind of have to differentiate between crypto, and we use quotes intentionally there, and Bitcoin. Bitcoin has a very different risk profile, it has a very different construction, a very different application, I would say, than all of this other stuff. And I think the problem is that whenever you start raising this in traditional circles, like I said earlier, well, we want exposure to Bitcoin, they tend to push you towards the Bitcoin miners, or they push you towards blockchain technology companies, which we believe largely on this call, those are kind of a waste of time. And they push you outside of what you should really be focused on, which is Bitcoin, the traditional non-correlated asset of Bitcoin, and holding Bitcoin if you can. So maybe we could explore that a little bit more, Dom.
Joe, that's a great point. I'll add a little bit on that. Big part of what we do is exactly that. We'll talk to investors that have exposure to other asset classes, and some are considering Bitcoin, but a lot of them haven't even heard about Bitcoin before and how it fits in a portfolio, right? And whenever they heard about all of these different things that are kind of like second or third or fourth, for not even derivatives of Bitcoin itself, right? And I think that becomes a little overwhelming and leads to normally people overthinking it and thinking that, like, this is way too complicated for me. This is an asset that I'm never going to understand. It's too volatile. It's way out there. There are too many complexities on this. When in fact, the core asset, which is Bitcoin, it's not that complicated. It's actually very simple. It's 100% transparent. We know exactly how many Bitcoins are out there at any given time. The issuance is predetermined. It's written in code. Couldn't be more transparent, right? And in fact, on a fundamental basis, it's exactly what you want in a portfolio. It's uncorrelated to everything else that you have, and with the potential, as Greg said, to be core insurance in the event, not for the day-to-day, but in the event of like the really distressed scenarios, right? A scenario where everything else is not working, there's potential for Bitcoin to work in that scenario. So 99% of the time, it's not going to work, or it's going to be flat, or it's going to be down. It's by design, right? And I think in the long term, the benefits of it, and we'll go through in this call, are many.
Yeah, I think an interesting point is, it's a new asset. It's also a new technology. We talk a lot about it as an asset on this show, but Steve and Mahlon, like it's a network too. And I think a lot of people don't realize that it is the world's most powerful decentralized network, in that there's over 17,000 computers across the world right now that are supporting this protocol, which is basically a decentralized transaction system. So there's a lot of different aspects to it, and we kind of get caught up in the asset side of it, but there is a network side of it. And there's a money usage side of it, with like something like the Lightning Network, where people are using it for day-to-day transactions. So I'm kind of in that camp too. It's a lot to take on, but my thing is, looking back at 2008 and the way that the ledger of the traditional finance system was balanced on the backs of workers, I don't put that out of the realm of possibility for happening again. And as we see, the money supply be inflated massively with the money printing that's just happened, I look at Bitcoin as kind of like something that I want to see unions look at and learn about. And even if they go take small positions, to be in a position to pivot if it starts to show that they may balance the legacy system on the backs of workers again, if that makes sense. And again, it's not out of the realm of possibility because they did it in 08. And that's kind of what we're recovering from, all these pension funds. And it's the easiest target if things go wrong to say, hey, let's cut some pension benefits, let's take some money from here and there, and let's make this all work out. So what
makes you think, Dom, that, and again, not knowing a lot about Bitcoin, but and anybody on the call can answer this, what makes you think, or how do you think, I guess is a better question, Bitcoin would have fared in 2008? Because everything was going to crap, right? I mean, what makes you think that Bitcoin would have been better served?
Can I take a stab at that?
Go for it.
Basically, as you know, Mahlon, 2008 was a credit event. It was driven by credit, excessive leverage in the credit markets, structured products built around subprime mortgages, all sorts of financial alchemy that included things like CBOs, which stand for collateralized bond obligations, and then collateralized bond obligations squared. Again, it's an engineering alchemy of risk transfer that was built on Wall Street extracting fees at the expense of sometimes pension plans, certainly foreign insurance companies, overseas insurance companies that were buying things that they believed were AAA rated risk. And they thought they would earn excessive returns on that risk, when in fact the risk was much more like a triple B, very low investment grade type of risk. So when these things got marked to market and the leverage was being unwound in the system, pension funds got crushed, or asset managers got crushed that held these securities. There were certain hedge funds that were actually short the securities that made money on them. But let's focus on the meat and potatoes where people got crushed. Why did they get crushed? It was a credit event. And as a credit trader, I believe Bitcoin, this is the Foss view, to be credit insurance. So I believe in a well-developed system in 2008, meaning Bitcoin had existed for at least a decade prior to that, Bitcoin would have been an outperformer. It would have hedged your portfolio. It would have skyrocketed in value because it's insurance. And when you are short credit, and this is the thing I need you to understand, when you are short credit, meaning you have a short position in credit, you are actually long insurance. Well, given that Bitcoin is a short credit instrument and you are long insurance in a very efficient market in 2008, meaning people understood exactly what Bitcoin was, I believe it would have provided excessive upside returns. And that's why I like Bitcoin going forward, because I believe there will be, as there always is, another credit event in the world, because they happen regularly, like a bus going around, another credit event where Bitcoin will show its true colors as an insurance policy, the equivalent of being a short credit, meaning you're not long credit, you're short credit instrument. I hope that helps.
Yeah, let me, if I can, I want to give you sort of an alternative take, because I have a slightly different opinion than my friend Greg here. And my view on this is that the world is trapped in a position where we have to have rising asset prices because of pensions, because of a whole lot of different scenarios. And when you have a credit event like Greg's alluding to, You have invariably, if there aren't policymakers that step in, both from the fiscal side, from the government trying to bail out people, or from the monetary side, the Federal Reserve trying to inflate asset prices, you will have a deleveraging event where correlations across the board go to zero. This is why during the GFC, during the Great Financial Crisis, you saw real estate decline, you saw the stock market decline, you saw problems in the bond market and credit markets as a whole. And in that event, because of the fragility in the system, it will, as Greg says, it will necessarily come again. But the reason you want to own Bitcoin, in my opinion, is because the only way policymakers can respond to something like that is by effectively stimulating, either on the fiscal or monetary side. And you saw a little bit of this during COVID, right? The policymakers could not withstand the system falling apart. So if the Federal Reserve needs to buy junk bonds, they'll buy junk bonds. If the Congress needs to mail out stimmy checks to every single man, woman, and child and dog in America, they will do that. They'll do whatever it takes to reinflate the bubble. But the difference between these other assets like stocks and bonds, which I think would probably make up a majority of the holdings of your pension fund, and Bitcoin has this principle of infinite scarcity, right? There's only a certain number of Bitcoin in circulation. So to answer your question directly, I think Bitcoin would take it on the teeth. I think the Bitcoin price in the short term would probably go down very rapidly. But as long-term investors with pension obligations, you need to think not just a year out or 2 years out, you're thinking 10 years out. And the reason you want to hold Bitcoin is because on the other side of that, when they attempt to reinflate the bubble, Bitcoin will be the fastest horse in the race because of that very infinite scarcity that only a certain amount of Bitcoin will ever exist because it's in the code and it's a consensus mechanism that the people that are participating in the network do not want to change. You want to buy Bitcoin for what comes on the other side of that credit event. And I think we'll probably see a lot of credit events like that, a lot of deleveraging events just because of the fragility in the system. So my view.
And
but
let me finish. I think that giving a perspective is kind of like in between and a little bit, I think, in line with what was just said. So first of all, Bitcoin was designed right after the 2008 financial crisis, right? In fact, Satoshi Nakamoto went as far to write in the first block that was ever produced with Bitcoin transaction in January 3rd, 2009. There's actually a reference there to the times and the crisis that was happening, right? It says the chancellor on the brink of the second bailout of banks. And this is a direct reference to the crisis. So the design of Bitcoin on purpose was made to kind of like be an alternative to everything that we were seeing and everything that was wrong at that time. I lived through the financial crisis, and it's amazing that, we read about it right now, and people have this tendency of thinking that, no, this kind of like happened out of the blue. It didn't, it was pre-announced since 2006. A lot of us were pounding on the table saying this is going to happen. There are all these risks, all of these things are unsustainable, sometimes they're going to explode, and they did. I think, in a sense, governments were very effective in fighting that. But what they did is that they just pushed the can down the road. We still have the problem, the fundamental problems, as Joe was saying, the fundamental products of credit, of a credit-based system are still there, still going to be there. And that's still a problem for the long term. Going back to how I think it would have fared, I think very, very much in line with what Joe said. Let's go back to March of 2020 and see what happened, because I think that's kind of like a mini example of what we would have seen in a situation like that, right? So first of all, when everything collapsed, markets went down, right? Bitcoin went down as well. So the correlation went to 1 in that small period of time in March of 2020, where everything went down. Bitcoin went down as well. Why? Because first of all, it's a liquid asset. It's 24/7. It's easy to sell. The same way that if we go back to 2008, for example, we saw things like MLPs, which have no correlation. They shouldn't have sold out. These were infrastructure products, but because they were liquid, right, and because Lehman had a lot of them in their balance sheet at that time, they went down together with stocks and everything else.
And gold.
Even though,
and gold too.
Gold exactly. Because they're liquid, right? And they're easy to sell, and they're getting margin called. They need to raise capital. First thing they sell, it's whatever they have available to sell. They don't care about fundamentals. It's not like they're stopped and say, okay, this thing has better long-term value than this thing, right? No, they need the cash. They're going to sell whatever they can get out for cash. This happened in March 2020. And then to Joe's point, fast forward and see what happened, not in March, but what happened throughout 2020. The governments came in, printed a lot of money, injected a lot of money, liquidity blew out again, and guess what? Bitcoin went up significantly, right? I wouldn't compare that, I think, to like a stress situation, because in that case, there's so much liquidity that, every risk asset went up. But I think it's a good example for us to think about and rethink about the ultimate thing. When we're talking about portfolio allocation, what you want to have is lack of correlation to everything else that you have, right? You want an asset that everything else is not performing, it will perform well, and not by any other thing other than the fundamental way that it's designed. And I'll go back to my first point, Bitcoin, and it may not do exactly that, but it was designed to have, as a solution to what we were seeing during the financial crisis.
Yeah, and to bring it home on just like a value system side, what I remember a lot, I was young, so I didn't care about money when the financial crisis hit, of course. I just was like, you guys remember, I was like 25 in the fire service, and I'm like, I just want to run calls, travel. Like, I want $0 in my account. I just want to spend my check as fast as I can. People were like, buy property. And I'm like, stop bothering me, buy property. Like, what are you even talking about? But I do remember this kind of like common understanding that the system, once it collapsed, that those who were responsible for the collapse would kind of just skate through, that the system would be rebuilt, and that the people that were going to take the hardest hit were going to be the workers, folks like us who have to work triple time to try to balance these pensions and then explain to taxpayers why it's important, and making sure that workers get their retirement. So to answer the question, Mahlon, which I thought is one of the best questions I've heard in Bitcoin, because we don't talk about it that much. How would it have performed in the 2008 crisis? I think if people knew about the system, and if that system where it was, if it was now where it was, if that happened and it is where it is now, I think people would choose to rebuild on the Bitcoin system because they would be disgusted with kind of like how things were put back together, but there was no alternative. And I think that it's now that you have a $500 billion plus asset class, which is the most powerful digital network on the planet, I think people might look at that and go, I don't want to rebuild this system that put us through hell. I want to rebuild on a different system, on a different platform. Kind of my take.
Just Dom, that's a great point. But and one other thing to think in context here, right? Even at 500 billion, Bitcoin is smaller than many companies, several companies at least in the S&P 500, right? There are $1 trillion companies out there. So you kind of have to judge Bitcoin for where it's at in its place right now in its development. It's a very small, nascent asset class. It's developing and getting bigger. And one of the hopes of many of us in Bitcoin is that if you get it to a $10 trillion market cap, a $20 trillion market cap, which may sound crazy, I think it's not. I think it's very realistic in the long term. It's going to have this more of a non-correlation with other assets. So it will be able to withstand those high moments of volatility. It will be able to not have the correlation go to one like Alpha Zeta was talking about. It'll have a sort of an actual function more in the future. It will probably function more like what Greg's suggesting, like an insurance policy, right? But it has to get bigger. And one of the beauty is now we're in this sort of once in a generation build out of Bitcoin as a store of value, and it presents a great opportunity for those who identify what this asset has the potential to be.
So
with just to
never always wanting to have the last word, living in your attic here, in the Canada being the attic of the U.S., gentlemen. I'm shouting down from the attic. In my defense, I did say, I hope you heard this, in a well-developed, efficient market, Bitcoin would outperform. We're nowhere close to that right now. And that needs to be stated again. And Joe and Alpha Zeta are correct that you don't sell what you want to, you sell what you can. And anything that has a bid gets hit because most of the stuff has no bid. The markets go no bid. Nobody wants to own more of anything unless they're short and they're covering. So in a well-developed market, in a future credit event, if correlations are well understood, you will have non-correlated assets where people will understand the absolute value of a non-correlated asset like an insurance policy. So 100% agree that if we hit a credit event tomorrow, Bitcoin falls in price. I believe it will recover quickly, but who knows? The next credit event may be the last one. Because believe it or not, there will be a last credit event, people. It happens until it doesn't rescue itself. And all you have to do is look at countries like Argentina or Venezuela, where they actually have to restructure. So I'm not predicting that for the great USA, and I don't want that to happen for the great USA, but you gotta plan for these potential outcomes, and they are very small, but not zero outcomes. And as we keep kicking the can down the road in the fiat system by printing more money, the probability that something breaks increases. So that again is the insurance side of the equation. But having managed money for a long time in my career, there's nothing worse than getting redeemed. Meaning your fund is outperforming, but people still want to take money away from you because at least they can say they made money on something. And that's a heck of a job to manage that risk. You're doing better, you're posting positive returns, and people are still redeeming you because they're getting crushed everywhere else so badly. They want to take profits or sell something at a profit. So the world of managing money is very difficult, to each his own, but over time, stressing what Alpha Zeta said, Bitcoin was designed because of the great financial crisis. And I believe in the future, when it reaches its ultimate asset valuation of trillions and tens of trillions of dollars, it will be treated more like an efficient, non-correlated asset. But we're not there yet. So thanks for giving me the very valuable feedback.
Yeah, I think for Steve and Mahlon, like it's valuable to talk about what ifs. At the start of the show, we talked about a selection that you obviously know we're long on Bitcoin. Last show we made a hypothetical selection for the Ontario teachers. Rapha, you have where that selection is, right? So the all-knowing board, we're a little bit down on that selection, and I'm kind of curious from you guys, hypothetically, if you brought something like this to the investment board and it was down some, what would you guys be up against as far as like members? Because there's a real world to this where you bring something new to a pension fund, and if it doesn't perform well, you guys catch heat. So Rapha, do you have the numbers on that?
I do, yeah. So let's go back and a very quick recap of what we went through in the last time, right? So we did an exercise very similar to the one we're going to do today. So in that case, we went back, look at the asset allocation of the Ontario Teachers Pension Fund. We saw what their allocation was. And then we analyzed and saw, does Bitcoin fit in this portfolio? And our recommendation was to set an allocation that was between 1% and 3% of that portfolio to Bitcoin. This was end of June. Since then, Bitcoin is down. It's down 15%, right? Or close to 15% since that period. So, of course, that wouldn't have helped in the allocation. That was a 2% allocation. The portfolio as a whole, so this is the performance of the overall portfolio in the last 3 months with and without Bitcoin. Didn't change that much because it's a small allocation, but regardless, right? It makes for these are hard conversations to have. We know that people look at the returns on a quarter-by-quarter basis. They look at returns on, if much, at a year-by-year basis. And you would have to justify, if you're a manager and you're down 15%, in the last 2 months, 3 months, that's a tough conversation to have, right? And that's part, I think, of what we've discussed, also thinking about, first of all, sizing it appropriately. It's the key here. So a 2% allocation, even though hurts, it's not going to destroy a portfolio. While on the upside, right, if Bitcoin really captures, as we were seeing, the market cap of other assets out there, like real estate, even part of it, right, real estate, equities, bonds, the upside potential is significant. We say a lot that Bitcoin is an asymmetric bet. What we mean with that is that if it doesn't work in your way, you know what you're going to lose, right? Here, you're going to lose the 2% allocation. That's the maximum you're going to lose. You can't lose more than that. But if it does work, the potential of upside for Bitcoin, as we've seen in the past, is significant and it's massive, right? I'll just finish by saying something that I think it's really important to put in perspective, is that Bitcoin is first of all, it's very early. So an asset that is very early, by definition, will be very volatile, right? Because it's still, there are a lot of people in the market that don't know how to price it. You know, there's some people that price it very well and look at it and say, okay, this is worth billions of dollars. There are people that look at it and say, this is worthless, right? And you have everything in between. So this leads, of course, to volatility if the players come in and out of this market. But second, which I would say about the overall portfolio, is that on the long term, right, when you look at the performance of Bitcoin does two things most of the time. It's either going sideways or it's I should just share the I don't know if I'm sharing the right. Can you guys see my screen?
We can now.
Okay, perfect. So yeah, so this is a transparent, it's there in the Nakamoto Portfolio website. So the performance is there, but just to finalize, I was talking about Bitcoin's return. Most of the times, Bitcoin's an asset that stays sideways or going down, right? The returns of Bitcoin historically have happened in very short periods of time, which make these conversations even harder because you are gonna have 11 months out of the year that you're basically going to look at it and it's either not going anywhere or it's actually going down if it performs the same way that it has performed in the past. And then you're going to have very short periods of time that is performing extremely well, right? And you can see that in the returns, which is usually what happens. By definition, just I think something important to highlight is every 4 years, Bitcoin has this event that is called the halving event. So what happens is that the issuance of Bitcoin is cut in half, right? In order to get to the maximum of 21 million Bitcoins that it's ever going to be issued, it's a declining curve. So every 4 years, there's less and less Bitcoin being issued. So if you think about in terms of the terms that we're used to in the financial system, this is kind of like declining inflation that is programmatic, right? So instead of having inflation that you don't understand, that you don't know how much money is going to be printed, the inflation Bitcoin is pre-programmed, it's written in code, cannot be changed, and it will eventually lead to the 21 million Bitcoin at the end of the day. But I'll stop here, and then we'll go back and we'll do the same thing, I think, for the Wisconsin fund here.
Well, I just want to ask Steve and Mahlon real quick. This is probably like drinking from a fire hose here with all this information. And I've had a lot of these conversations with people that come in with no knowledge base, whatever, and they say you're speaking a different language to me. What questions do you have? What of everything we've said so far here? What are you still in sort of the dark as to what this thing even is? You know, can you explain it simply? Where do you stand on it right now after hearing all this?
Go ahead, Steve. I asked my first question.
Which was a great question, man.
So, I mean, I know what Bitcoin is, but I don't know just fundamentally. So I'm learning. So I mean, I have a better understanding now than I did before we started. But I'm not sure how you actually introduce this into, like, in our system. I already told you guys, the annuitants are already writing letters to the board asking if we are involved in this. And it wasn't a positive letter. It was
negative, right?
Negative.
You know why that is?
That's the way I took it.
Based
on the way it was being portrayed from the staff.
And it's justified, and I'll tell you, it is absolutely justified. You know why? Because there's a tremendous amount of people out there in the larger crypto space, which is what we alluded to earlier, that are just outright frauds and scammers. I deal with this every day as a litigator, right? Half of my practice is involving scammers or frauds or someone who stole money or misrepresented what they're doing. And that's all crypto, right? And Bitcoin's very different. That's why we wanted to distinguish the two at the beginning, because the public, when they turn on the news, they see FTX. They see these big exchanges where there was a bunch of people stealing money and it was all a fraud and somebody was enriched and it was a scam, again, by very well-to-do insiders perpetrated on hardworking people, and the money's gone, right? It's gone. And I think that people that are rightfully concerned, do we have exposure to this industry? The problem is it's not this industry. Bitcoin is different from these other things. And I think any discussion has to start with explaining how what Satoshi Nakamoto and those who created Bitcoin did is separate and apart from the broader crypto industry, which I agree with. Most of it is just a scam and a fraud perpetrated on hardworking people and preying on their dreams that they can have, a better future and have more better returns on their investments. So I don't know if Greg has any comment on this part or anyone else. Dom, want to weigh in?
I got something real quick. And that's a great point, Joe and Steve and Mahlon. One of the things, so, hey, putting myself in your guys' shoes, I was the president of my fire association for many years. There was only 120 members, so I don't know how you guys do 4,000 members, because I'm exhausted and I'm moving on to like, an island somewhere just from 120. But I think the sweet spot for pensions, for unions, is allocations that are small enough to lose and learn with, to open the door and kind of build that education. And so, Steve, when you say like, people are writing from a place of concern, or how would it fit in, I view it in a very small amount to where it's inconsequential on both sides. It's inconsequential on what would happen if it was lost, and it's inconsequential if it were to go up by 100, 200%. But until that knowledge of how it fits in with the portfolio, I'm a huge fan of starting very incrementally and then bringing education to overcome some of those fears, right? We're like, oh, I just saw this thing in the media about a collapse. How's our investment doing? Oh, it's only down, 15%, 20%. So, look, we're okay. And sometimes for a lot of people with something new, they just need to hear we're okay and it's inconsequential, because as you know, when it's significant, the fear kicks in and people start to get very anxious and they want to pull out. And so I know for you guys, one of the big obstacles, if you were to introduce Bitcoin, would be the minute that you had a negative media attention on it, you guys would start getting hit with more letters, right? What are you doing, Steve? We had a great thing going with the Wisconsin retirement system. You put us in this very compromising spot. Whereas if it's a small amount, you can say, listen, this is a spec of our investment fund. It is a learning investment. And that's how it's pitched, if that makes sense.
Let's be clear though, guys. Let's start with the basics. First of all, perhaps what you do is you get Steve and Mahlon a Bitcoin wallet. Okay. And I'd be happy to send you a few what's called Satoshis. And gentlemen, once you feel this technology in your hand where you can transfer value over time and space anywhere in the world, and it will settle sometimes instantaneously, sometimes it takes 10 minutes if you do it on the Bitcoin blockchain, perhaps you start with that education process. You do a lot of homework on Bitcoin before you put it on any asset platform. But most importantly, Dom, you never make an investment to learn with real money. You learn with fake money. And then you get comfortable with it and you actually put it to work for real. Because yes, if it's 1% of your portfolio and it goes down to 0, you've lost 1%. But here is the asymmetry of the trade, gentlemen. Dom said it could go up by 100 or 200%. No. Yes, it can go up by 100 or 200%, which is 1 to 2 times. This particular asset can go up by 50 to 100 times, which means your 1% allocation turns into a 100% portfolio allocation if you don't rebalance, which is to say you've doubled the size of your fund. Now, it's not a certainty, but it is a possibility. And this is why you need to do expected value analysis, distribution of potential outcomes, and understand you never, ever, ever make an investment to lose money. If you do, you're fired. You're out, you're gone, you are a loser. But you study it, you understand it, and you take the risk when you have evaluated the expected outcomes. And I'll tell you, Bitcoin is the most exciting, best asymmetric investment opportunity I have ever seen in 35 years of managing money. But if you ever said, Greg Foss put a position on a book to lose money, fire my fucking ass and get me out of Dodge. There's the swear word you were looking for. Thank you.
And Greg's audition for the Wisconsin hockey coach is solidified for Firefighter Olympics 2023.
Dom, let me just add two quick things. The first one is Bitcoin is an asset that when you look at it, I think it's something that we've never seen in history in the sense that it's an individual revolution, right? So what Greg said is absolutely right. It usually starts with an individual instead of a corporation. And I can tell you from personal experience, like going to Bitcoin, I try time and time again to pitch it to my own companies, to put it in the balance sheet, to go out in the banks that I worked. Or I worked at Goldman. I tried to present Bitcoin for Goldman. That was a disaster. Deutsche Bank, the same thing. That was a disaster. But then you fast forward, and most recently, when I started telling people that I wasn't more into Bitcoin, I can tell you the number of people that came out from those places and reached out to me and said, yeah, I'm a Bitcoiner. I've had Bitcoin in my personal balance sheet for a long time, but I just got tired of trying to change the system and tell people where it fits in an asset allocation, because it's very hard to change the mindset, I think, of big, as you guys know, of big investment committees, of policies and all of that for an asset that it is different. It's very different in terms of risk reward and in terms of returns, right? And the other thing I will mention very quickly, it's a quick story that most people here have heard me tell, but it's kind of like how I started looking at developing something like the Nakamoto portfolio. I had a very good friend that same thing, has been investing for a long time. He's a banker or owns a bank globally. And we were talking about different things. And, I always told him about Bitcoin. He couldn't get across Bitcoin. It's like, I don't know, it's just too volatile. It doesn't fit my profile. And I kind of like left it alone. But then I came back to him a while afterwards, and I showed him the Bitcoin returns in a piece of paper, telling him that, imagine, this is a hedge fund manager, right? These are the returns of the hedge fund manager. See how it fits in your portfolio. And when he did that, when he looked at the returns just as an asset, just like a hedge fund manager, right? Thinking about not about the technology, not about an asset that he doesn't understand, that he has 1,000 different questions, but just as an investment in the portfolio. And two things popped to his attention. The first one, which is obvious, is the long-term returns are very good. But the second one, as I mentioned before, it's an asset that it's completely uncorrelated to whatever he had on his portfolio. And his immediate reaction was, I want to know who this manager is, because this kind of risk return profile is exactly what I'm looking for in terms of asset allocation. And then I told him, this is Bitcoin. And then he was kind of like taken back. It's like, oh, okay, maybe I'm overthinking this, and I'm trying to think about different things in a way that I shouldn't. And I should just first maybe start as an investment, like I would in anything else. Because if it was a hedge fund manager coming to me with these returns, I wouldn't be asking all these questions, right? So maybe I should do the same thing here. And today he's a big Bitcoiner. So
yeah, the to add on to this, in 2014, Gavin Newsom tweeted about Bitcoin, and he said, I'm interested in figuring out how Bitcoin can be used for political donations. At that time, CalPERS had a fund balance of 300 billion. If they would have put 1% at the time of that tweet for a total of 3 billion, their return to date, I did a little while ago, would have been $186 billion. CalPERS has a lot of challenges right now, funded at 72%. So they're trying to figure out how to make things work. You guys aren't in that same position. You guys are in an incredible position. But to speak on Foss's point, the small allocations for something this new can provide a lot of freedom and ability to move and not be vulnerable to the legacy system over time. And so I think it's definite. There's opportunity there. I know one of the things we do, at the end is we kind of make a hypothetical allocation, the hosts, after the show. But any other questions from you guys, thoughts, like kind of things that you see for institutions that are kind of roadblocks for Bitcoin, or things that the Bitcoin community can do better to make, bring better education to light?
I think, I've learned a lot today just sitting here for the last hour and 4 minutes. It's been quite enlightening, in all honesty. And now I can share the message, at least, so I can push it. I mean, we have investments, our own investment strategy here at the PFW, and our own investment account. And I have an investment account. We do a Vanguard at my local that's managed by our investment team. So it's something I'm going to look into now. I can tell you that now that I
Yeah,
know
one
more.
thing when you're looking into it, just to be able to speak with experience, as Greg said, I really think it's key. I think there's tons of people who have read a lot about Bitcoin and heard all the negatives or heard some of the positives, like you're probably doing on this podcast. When you actually experience it, when you send a Bitcoin transaction on chain, when you see it just like sending an email, but it's a uncopyable type of code, right? That's the beauty of Bitcoin, that they figure out how to do digital scarcity. When you send that and experience that firsthand, what that's like to have ownership of your money, to have it in control, to be able to send it instantly, globally, anywhere in the world, and have final settlement in a relatively short period of time, it will change your outlook. I think that is it's kind of like trying to explain the internet to somebody, right? If you heard about the internet for years and years, but you never actually booted up, AOL at the time or any other browser and experienced or sent an email, it's just kind of, it doesn't translate. You have to actually experience it in real time, and it'll change your view of it. And then when you go talk to folks and have these meetings, you're speaking from experience. You're saying, I've sent Bitcoin. I understand how the tech functions. I may not understand everything, but at least I understand enough to basically do the work on it. So I highly suggest you take Greg up on his offer, because I think that would be extremely informative.
Yeah, and I think doing that before the spot ETF is approved, which you guys will be in a good position. The Bitcoin spot ETF, we believe, will be approved, thus opening the door for institutions to invest with a firm like BlackRock or Fidelity. But to do that before that happens and hold Bitcoin in self-custody, I think you'll be in a very important position if your fund starts looking at Bitcoin to say, hey guys, this is not exactly the same as self-custody, which we learned about. We're investing with a firm that will hold Bitcoin, and that may be the best vehicle for the pension. But there's something different here for holding. Maybe there's value to that, to the union, right? Where the pension fund can't hold Bitcoin, but you might be able to have your fund as Wisconsin hold a little bit of Bitcoin, like you would hold something in your own vault that the members own and control outside of any third party.
So a shout out here to some of the comments, you guys. I'm not sure if you're reading them, Mahlon and Steve, but from the Coin Father, amazing Bitcoin in Wisconsin. I'm located in Wisconsin and have been to lots of orange pilling in the Madison area. Instead of orange pulling, it should be orange pilling. Orange pilling is an expression, gentlemen, which means you've been orange pilled. Bitcoin is the orange logo. You take the Bitcoin pill. It's not crypto, it's Bitcoin. Bitcoin is non-fiat. Bitcoin is scarce. There's only 21 million of them that will ever be in circulation. And that 21 million scarcity is the exciting asymmetry to the upside that will provide asymmetric returns for investors that buy Bitcoin at the right price. And what is the right price for Bitcoin? It's certainly not its current trading value, in my opinion. The correct price for Bitcoin should be far, far higher relative to its intrinsic value as insurance. But we don't need to go there. All you need to understand is you need to do the homework on behalf of your beneficiaries as to why Bitcoin could potentially be the greatest asymmetric return asset known to man. And I'll just summarize with this. You can do that using the NakamotoPortfolio.com. I want to get into those numbers because Alpha Zeta has designed a beautiful model that allows you to reduce risk. Listen carefully. You can reduce your portfolio risk while at the same time maintaining the same portfolio expected returns. Or the flip side is you keep the same portfolio risk by adding Bitcoin and you increase your expected returns. It's exactly what managing money is meant to be. Increase returns, keep the same level of risk. Because why? It's a non-correlated asset with substantial upside asymmetry. Over to you guys.
And Foss will coach the hockey team for free. Just know that
I heard
offer stands.
I heard him say that he was sending me and Steve Bitcoin. That's what I
You guys can get a wallet, and I'd be happy to do that, gentlemen. That will be the challenge through Dom Bay, and you will see how cool it is. But Wisconsin does not need my help. They are a fantastic hockey program and a fantastically coached team. My hat's off to the sport. Americans, we're still dominating for a little while, but mathematically, America will be the hockey capital of the world soon. Just by numbers. It's only math. You guys have more people in minor hockey than Canada does. What does that mean? Most of the better hockey players in the world are going to come out of the United States. Please learn math. Please learn expected value outcomes. I'm telling you, the best hockey players in the future are going to come from the United States because it's only math. Bitcoin is only math. Bank it. Love you guys.
Hey, I'll also add on and send some sats your guys' way. We will get that set up. I just want to say before we kind of get the host into a different room to make a hypothetical selection, Wisconsin Firefighters is extremely lucky to have you guys at the helm. Your willingness to take a look at this, I think, is speaks in volumes to your willingness to kind of put yourself out there for something that's new, that you guys aren't super educated on. And I know, Steve, your work for the pension fund is not just helping firefighters in Wisconsin, but the entire state, public workers and municipalities that, in my opinion, these workers keep the world moving forward, and they're one of the, few workforces that are there all the time in our toughest times. So thank you guys. And really, I hope I can come visit you guys soon because you guys are doing great work. So,
Thank you guys.
Yeah, thank you.
And I'll tell you, Greg, if Minnesota invaded Canada and won, they could call it can of soda.
Did you know that in Toronto, the entire state of North Dakota is further north than the city of Toronto? So there's lots of America, including the entire state of Minnesota, which has worse weather than Southern Ontario. Not surprising you guys are darn good at hockey. We don't need any more cold weather states. We need to take over some of those Southern Florida states or whatever. But let's switch gears. Rapha, did you run the recommended portfolio allocation by any chance for Wisconsin?
I did. Yeah, that's what we're going to go through.
What is the number? Because I've been here for 75 minutes. And I'm dying to know what the right portfolio allocation is for the state of Wisconsin investment board.
Yeah, so the good thing, and I'll go quick because then we'll deep dive into this, but they have a bucket in the portfolio, which I love to see, which is their inflation sensitive bucket on their core portfolio. Bitcoin should be a part of that. That's 19% of the overall portfolio. My suggestion is for the same way that we've looked before. I think anywhere between a 2 to 3% allocation would be ideal. If you just run the models, the numbers are, of course, way higher than that because Bitcoin has low correlation to the overall portfolio. And particularly on this inflation part, it can add a lot of value. So we'll go through the numbers, but they're high, right? And I think that as in the last time, the recommendation we should discuss this is to start small, get in, as we discussed, learn about it, and then build an allocation with time.
What is the recommended allocation, Rapha? Don't dodge the question.
So on a risk-adjusted basis, let me share the screen very quickly before we break out. So can you guys see the screen?
I can see it.
Yep.
Yeah. So I started with the core portfolio, right? The core portfolio, there are two portfolios there. There's the core portfolio and the variable fund portfolio. The core is where 80% of the assets are. So I use that as a benchmark, right? As I said, I'm using the inflation sensitive bucket to allocate part of that to Bitcoin. But if we look into the overall return, so let me just share this tab here. So this is what I was mentioning, right? So this is the core asset allocation, and you can see here the 19%. So ran the numbers, and this is the result. I'll jump through it very quickly. If you look here at the original portfolio, so this is a proxy. So what I did is I got what typical ETFs would be through each of those buckets, right? Ran the allocation, and then I ran it with a 1, a 2, and a 5% allocation first to see how it would have performed. So the original portfolio has good returns, right? We're talking about 6% returns, 6.16% historical returns, with a volatility which measure risk of around 12%, right? So adding a 2% allocation, which is what I'm mentioning, the 6% could go up to 8%. So this is the incredible thing, right? You're just adding 2%, it brings returns up by more than 2% over time. Of course, this is back tested. Of course, this is looking at what has happened in the past. Of course, Bitcoin had very good returns, but it gives a sense of the potential. And I think more importantly, as Greg was saying, in terms of the Sharpe ratio, which is a measure of risk-adjusted returns, right? So you see that adding Bitcoin, the returns go up to 8%, but also, and more importantly, right, you look at the overall volatility, it doesn't go up that much. It goes from 12.4 to 12.5. So when you look at the risk-adjusted returns, right, which is just a measure of adjusting risk by the volatility, it goes up significantly from 0.39 to 0.57. So in this portfolio, it makes a lot of sense to have Bitcoin. Answering Greg's question, if we go into an optimal Bitcoin allocation to the portfolio, trying to get to the optimal risk return, the right number is 6% for the portfolio. If you want to have equal risk, even in equal risk contribution, right, you're still Bitcoin is a 2% allocation, which is what we're proposing. So it makes a lot of sense. And just to cut to why that's the case, I think it's this chart just shows it very, very well. What is this? This is the correlation between Bitcoin and all other assets in this portfolio. So Bitcoin is this line right here. And you can see that, it has no correlation pretty much among any other asset class. And if you look at all of the other assets compared to the portfolio, their correlation is very high, right, to the overall portfolio. Bitcoin has the lowest correlation to the overall portfolio, which, again, makes a lot of sense. It's a testament to, I think, a lot of the things we've seen. We run these numbers for a lot of different entities, individuals, right, corporations, endowments, foundations, and I'm still to find the portfolio where Bitcoin doesn't fit. At the end of the day, if you have a diversified portfolio, it makes a lot of sense to have the exposure.
Those are good.
What an amazing tool.
Yeah.
What an amazing tool, guys. This is absolutely the language that your risk managers speak. Things like Sharpe ratio, expected return, volatility. This is what you're looking for in managing risk. And the fact that Rapha, or otherwise known as Alpha Zeta, you may not have put that together. That's his Twitter handle, by the way. Alpha Zeta has put this together for free. Open source software, which exists on the internet for anybody to analyze a portfolio and how Bitcoin impacts that portfolio. You cannot argue with it. Yes, you have to back test it because we can't predict what's going to happen in the future. But the reality is Bitcoin, again, in my opinion, offers the best asymmetry of any other asset out there. And that's because it's a new technology. It is widely misunderstood and therefore undervalued relative to its true price, which, saying it a different way, the price doesn't reflect its true value. So people who get in soon or early will reap the benefits of a underpriced asset. It's tough to make a recommendation to go up to 6%. But my only recommendation is over time, whether it's for the Wisconsin Investment Board or your own portfolios, gentlemen, please own more than zero. That's my only wish, is that you own more than zero, because the only wrong allocation to Bitcoin is zero.
Yep.
If you said we put 10 basis points, which you guys know means 1/10 of 1% in Bitcoin, it's a start. And if that 1/10 of 1% goes up tenfold because Bitcoin offers that asymmetry, all of a sudden it becomes a 1% holding. And if you still don't sell it and it goes up another 10 times, it's now a 10% holding. So 10 basis points turns into 10%. And by the way, it's very possible.
Yeah.
That's how I've always managed risk, distribution of returns. I'm going to go on quiet mode here because we need to make a portfolio allocation choice, I think.
Yep.
And I hope Joe returns to the fold soon.
We'll get him.
Steve and Mahlon, we'll make this all available. Like as Greg said, everything here is open source. It's available. It's open to anybody. We'll make a small write-up. It's going to be available. You can show this to anybody you want. You can change the allocation. You can change the numbers, right? 100% flexible. This is the same tool, by the way, that I used at Goldman to do analytics for my clients, and we used to charge them, I can tell you, much more than zero to do this kind of analytics. It wasn't zero. And the reason why I'm doing this is because, I truly believe Bitcoin has to be in every single portfolio. And most important, for clients and investors that are worried about, inflation as the core of their portfolio, as we should in pensions, right? Because at the end of the day, we need to make sure that the people can buy the meals and the food and everything else that they have. And this is all based on inflation, right? They need better money. And Bitcoin, at least I believe, is the best money we've ever seen.
Yeah. And this also serves as a good little, something in the file, because I know what a lot of the public doesn't know is the same members that'll go to a meeting. God forbid, if you guys brought Bitcoin to the members, they go, what are we doing? This is a terrible idea. If it goes up, they're going to come to the meeting and go, why didn't we look at this? This was a no-brainer, right? Like our members are irrational at best, and to have something to show them to go, well, hold on. We didn't get into Bitcoin, but we did due diligence. We looked at how it affected the portfolio. We didn't just not look at it. I think there's value to that too. So, hey, I know we've kept you guys on a long time. And we're here for you for any discussion, whether that's tomorrow or in a year. And I just want to thank you guys so much. I know Rapha and Greg, we're going to make a hypothetical allocation without you guys. So we don't want to make any confusion like you guys are making a allocation. We pretend to make one, but we'll definitely send you the allocation we make so you guys can rip us a new one if it goes down, over the next 6 months.
All right.
And a final shout out, fellas. There's a guy in the comment section on the right hand side, my right hand side of the screen. I can't get there. I don't know how to join that conversation because I'm technically illiterate. But it says by the Coin Father, he runs a Bitcoin meetup in Madison. Okay, so at Coin Father, who's obviously a local Wisconsinner. He runs a Bitcoin meetup, and he also said he's going to be at Pacific Bitcoin next month. And I look forward to meeting you, Coin Father.
Yeah, Coin Father, send me the info at Baywatch 1 on Twitter, and I'll get it to Mahlon, in case they're in the area and ever want to check it out, like a meetup or something like that. Shoot me that info for sure.
And thanks, guys. Mahlon and Steve, you guys are doing a credit for the children, for the kids, okay? That's what it's all about. Thank you. From the bottom of my heart, you're doing the homework. That's all we can ask.
Thank you guys. Appreciate your time and having us on.
Yeah.
Thank you.
Have a
Thank
good
you
one.
guys so much.
Out there.
Great presentation.
Yeah, we'll do.
Thank you.
Thank you guys. Thanks so much. Okay, so it is time now to make the hypothetical selection for the gauntlet. I think Joe had to take a quick call. He's got courtroom drama, Law and Order style. But we have Greg here, we have Rapha, and we're going to make now a hypothetical allocation as if we sat on the board of the Wisconsin retirement system. So without further ado, let's throw out some possible allocations, starting the bidding off with Foss. Where are you sitting at?
Yeah, it's at times like this where your gut would say use house money, meaning that they're 106% funded, or at one time we're 106% funded. Right now they're sort of closer to 100% funded, and take that incremental overfunding and put it all on black. Okay, but that's not how you manage risk. I would say that this particular fund, which has done so well with its existing portfolio, even though the optimal allocation, backward testing, is to put 6%, I would stick in the 1 to 2% range on this particular pension plan. Because why? It's already doing great. It doesn't need to reinvent risk management from a pension allocation. If this fund were only 42% funded, I would say, gentlemen, you're already a bunch of donkeys. You might as well try and break out of your box and manage risk properly. But these guys know how to manage risk. That's proven in the numbers. So I would say 2% would be the recommendation for this particular portfolio. Why? Not because 6% is wrong. And would I be happy that they went to 6%? Yes, I would. But this is basically the correlation with this portfolio, or non-correlation, is less than in other portfolios that I have seen. And therefore, 2% is the recommendation that Greg Foss would make for the state of Wisconsin Investment Board for Bitcoin.
Wow.
And no other crypto.
Yeah.
Just Bitcoin.
No ancillary, no picks and shovels, just own the real thing. Foss, impressed with your 2%. I would have thought you would have swung heavier, but I like the justification, and that's very tasty right now, the 2%. What about you, Rapha? Where are you sitting?
Yeah, this is going to be an easy conversation because I'm in the same range, right? Between 1 and 3%. I think 2% seems appropriate given what they already have in the portfolio. The portfolio is fairly well diversified. I think, they've had good returns. It's a different thing going forward. There's a separate discussion we didn't have, which is looking at, I think, a lot of the assets that they have. There's this huge discussion around the performance of the traditional 60-40 portfolio going forward. And they do have high correlation to a 60-40 portfolio, which is not good. But we can't, if this was my portfolio to run, I would probably, jump and say we need at least 10% of Bitcoin in the portfolio. But that's not, I need to manage expectations. And imagine if we've done that with Ontario and we went to 10%, which we thought it would be hard now to go back, and, people will be panicking. And so usually it's better to start, I think, small, between a 1 and 3% allocation. I think it's fine. And the other thing I would ask, John, is that if we could also go back and on the Ontario allocation, if you remember in the last show, we made a proposal to be between 1 and 3%. And we said, for now, we're going to start with 2%. I wanted to propose that we actually bump that up to 3% to get them, first of all, a better entry level. And second, I think it gets closer to what we think the overall long-term asset allocation should be. But I don't want to mix the discussions. Let's start with this one. But I think this is going to be an easy one. We're probably going to go around 2%. But what do you think, Dom?
I think so.
Hold on, Dom.
Yeah,
Dom.
yep.
I'm running this show. I'm running this show from your attic, Dom. So remember that, okay? So no, look.
I'm in the basement here.
I need to add this. I need to add this because you're totally right, guys. We haven't brought the rebalancing question to the table. And that is going to be a huge differentiator of future returns. When do you rebalance? When do you turn? If your 2% goes to 4%, do you harvest gains and push it back to 2%? That's the key of risk management in itself. And it takes the discussion to another level. So sorry to interrupt. I would also recommend always considering a rebalancing alternative when the price moves in one direction or another in the short term. In the long term, you always let your winners ride, guys. That's the way you manage risk. You shed your losers, you let your winners ride. So, sorry, Dom, over to you, sir.
Yeah, I think the Gauntlet board will approve the rebalancing for Ontario, although we'd have to decide where that would get pulled from. But for the Wisconsin retirement system, I know we lost Joe, but surprising, he got back to me and said he recommends 100% allocation to Bitcoin, which I was not expecting from Joe, to put the whole families and lives of Wisconsin on the line. I got to concur with the 100%. No, I'm just kidding. That would be reckless. I think the 2% is very good. I agree with it. I think Wisconsin's in a great spot, and I believe that their hypothetical 2% allocation to Bitcoin would put them in a position 5, 10, 15 years to be offering better benefits even to their employees and continue to attract a better workforce, and also weather whatever storms come up.
So Dom, you always say you're a grade 11 math. So if we're using $130 billion as their portfolio, what is a 2% allocation in dollar terms?
2.6 billion.
I love your grade 11 math, sir. That is a lot of coin, okay? That is a big slug of investment. So don't underestimate the impacts of big money moving in small percentages. 2.6 billion of buying power itself will move the price of Bitcoin higher, and this is part of the process. So once again, learn math, learn grade 11 math. Dom Bay, you're a star. Firefighters are amazing. Wisconsin hockey rocks. Love from Canada. I got to sign off as well. Ibex Mercado, if you don't know who they are, learn who they are. Rapha, your model's absolutely amazing.
Great seeing you guys.
Great job, guys. 2%. I think we'll do well for Wisconsin. Thank you, guys. Another great episode. And again, if you're listening and you want to get Bitcoin introduced to your pension fund, your union, your workplace, your workforce organization, send us a message and we'll try to get your pension fund as a guest on the show and teach them about Bitcoin and see what an allocation would do for them and what it would do for you as a worker. This is the Nakamoto Gauntlet. Thank you so much, everyone, for tuning in. We can't wait to catch you next time.